let's say there are 1,000 buyers who can afford a home with a 3% mortgage, but there are 800 buyers who can afford it at 4%. So we lost 200 buyers because the
Okay.
rates went up, right?
Yep.
And then there are just 600 buyers that can afford a home at a 5% mortgage. None of this really matters because there are only 100 homes for sale.
Okay. Got it. So you're saying the supply issue is the real issue.
Yeah. I mean, everybody's talking about nobody will be able to afford these houses because the rates have gone up. And that's sort of true, but it's not true at the same time. Because
Hmm.
what it means is the buyers in the marketplace will simply have to adjust their expectations down
Hmm.
to afford what they can. Or if they're first time buyers, they're just going to stay in the renter pool. And that's going to put upward pressure on rents. So investors are going to benefit from that.
Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I am here with Jason Hartman, who is the CEO of the Empowered Investor. And so just to kind of give everybody a little context, I met Jason. He was one of the keynote speakers at an event a couple weeks ago that was just a phenomenal event. It was called Market Disruptors Live. I watched his presentation. It was the longest presentation. He was given the most amount of time on stage. He opened the event, and honestly, it was straight fire. And it was I think 2 hours of just awesomeness, and the slides and the research. And so Jason does a lot of things when it comes to real estate investing. I haven't seen anybody in this space that has more statistics and just detailed research as to why they believe what they believe in the real estate market. And so I try to bring people onto this channel to kind of give different perspectives, right? Because I think the reality is, Jason, and I'll let you kind of take over with this too, because I think the reality is nobody really knows where this whole economy and whatnot is going, right? And everybody's kind of guessing to a certain extent. And there's certain variables that I think nobody can really put their finger on. But what I will say is, you have a lot of information and a lot of perspective, a lot of history. You've been doing this a long time. So above and beyond just your charts and the statistics and the graphs and everything that's going on, you've been around the block. You've gone through different markets and cycles and all these different things. So I think you have a really unique perspective to share with everybody.
Yeah, and I'm also getting feedback from, we have thousands and thousands of investors that are contacting us, and I'm constantly sensing what they're saying, what they're feeling as they share their emotions in the marketplace,
Yeah.
and where they're going. But I do have some very original research. As you know, I developed my own index called the Hartman Comparison Index, the HCI. And it really answers, Chris, what I think is life's most important question, and that is compared to what? And
Totally.
that's the most important question when valuing anything. We need to compare it to other things. And so, yeah, I'll share with your audience today some really new thinking on the real estate market, the macro economy in general, and where we're going. Now, of course, nobody has a crystal ball, and there are lots of factors that can change. We don't live in a logical economy. We lived in a centrally planned economy, and we never know what the central planners at the Federal Reserve and the government are going to do. So they have an impact, obviously a huge impact. But we can try and do the best we can with it. So here we go. So the first thing I'd like to share, and you see this on the screen for those of you watching on video, that last year we had an incredible amount of homeowner equity increase. And you see here that equity increased by 31% in people's homes around the country. That's $3.2 trillion. That's trillion with a T. And that is a giant number in an economy that's just over $20 trillion to see just home equity increase. I mean,
It's monstrous.
it's truly amazing. And as we kind of look at this stuff, I think this little meme that I posted on social media sums up the market pretty well. But I'm going to make a modification to it today for the first time. Okay, so
Nice.
let's just review this. And it says, let's say there are 1,000 buyers who can afford a home with a 3% mortgage, but there are 800 buyers who can afford it at 4%. So we lost 200 buyers because the
Okay.
rates went up, right?
Yep.
And then there are just 600 buyers that can afford a home at a 5% mortgage. None of this really matters because there are only 100 homes for sale.
Okay, got it. So you're saying the supply issue is the real issue.
Yeah. I mean, everybody's talking about nobody will be able to afford these houses because the rates have gone up. And that's sort of true, but it's not true at the same time. Because
Mhm.
what it means is the buyers in the marketplace will simply have to adjust their expectations down
Mhm.
to afford what they can. Or if they're first time buyers, they're just going to stay in the renter pool. And that's going to put upward pressure on rents. So investors are going to benefit from that.
Yeah.
Okay. Here's my modification to this. You know, it's this is not statistics. This is just a meme, okay, to illustrate a
Okay.
point. But now I would cross out this there are only 100 homes for sale, and I would say there are 110 homes for sale
Okay.
because inventory has ticked up ever so slightly.
Sure.
It's like a nothing burger, okay? But it has gone up. And it's going to be really critical the next, say, 2 months or so to see where things are going. Now, just to give a comparison, here's how we started off the year. We had about 293,000 homes for sale. Back in 2015, there were almost 1.2, or there were about 1.2 million homes for sale. That's incredible, right? And we
That's
thought,
yeah.
okay, with the rising rates, inventory is going to come way up and there's going to be less demand. But the opposite happened. At the end of the first quarter, we only had 241,000 homes for sale. Okay, now I do want to say be careful because there are different statistics, different groups that put out different kinds of numbers on this. For example, the National Association of Realtors, they'll quote a higher inventory number because they count it differently. They count contingent sales and pending sales as inventory. I don't think that's a very good way to do it. I only want to see homes that are actually for sale that you could buy today. Okay.
Yeah.
So just that's just something to know. But inventory is way down from where it needs to be in a normal market. It has ticked up just ever so slightly recently, but
Mm.
again, it's just not even almost worth mentioning yet. Now that trend could continue, and we could see inventory increase, but that remains to be seen. So
So
far, right now, it's like going into the grocery store and seeing 66 to 80% of the shelves vacant, where there's nothing, they're empty, there's no product for sale, and I think that's a good metaphor for people to think about when they consider housing inventory.
that's awesome perspective. So you touched on this at the conference when you showed that slide. That can you elaborate on why you choose Altos Research? Because
Yeah,
you
because
really
they count
focused
the
on that.
homes for sale.
Okay.
That's what they're counting. Homes that are actually for sale, not pending, not
Okay.
contingent sales. And I think that's a much more accurate way to do it. And as long as you're comparing apples to apples historically, you could use the NAR data, you could use
Mhm.
this data, whatever you want, just use the same comparison. I
Right.
just want to say that though, because if people hear this or see this interview and they say, well, according to National Association of Realtors, Jason Hartman's wrong. Well, no, I'm not. I'm just not using their data because I don't like the way they do it. I don't think it's accurate. Okay.
Yeah, and I think having a third party company doing research firm doing this data as well as there's no conflict of interest like there is potentially with the National
Yeah, I
Association of
mean,
Realtors
of
as
course,
well.
NAR wants to, rally the housing market, right?
Sure.
That's what they
Yeah, yeah,
do.
yeah,
You can't blame
yeah,
them. But whatever.
yeah.
Yeah, I agree with you there.
So if we were to zoom that chart out a little bit and
Mhm.
go back from, because I think that went back to 2015 and
Yeah.
inventory was over 1.1 million. We're at 241,000 now, so that's obviously a significant decline, right? And so
Oh, very significant. I mean, there's, it's a figure of speech, of course, but realtors and buyers are saying there's no inventory, and they're
right,
still right. Now,
yeah,
again, if we see it tick up a lot, that'll be the sign that the market really is transitioning. I think it's ever so slightly transitioning now, but
yeah.
it's just not even, it's like such a nuance. It's just not enough to consider yet.
So based on your research and kind of your experience, what is the number where you think a healthy inventory number is for today's economy? Like, where do you think that inventory number needs to get to before we start running into?
900,000 to 1.5 million.
So that's
So
the
we
range
are
that
we are
typically.
1/3 to 1/5 of the inventory we need to have a normal market. Now that's just a normal market. That's not a bad market. It's not a buyer's market. It's not a recessionary market. It's just a
Right.
normal market. So
Okay.
we have a long way to go
Okay.
before the real estate crash comes. Okay, it's just. I mean, look, there will be an adjustment at some point. There are cycles. That's the way
Mm-hmm.
business works. I mean, if you follow the Austrian School of Economics, as do I,
Yep.
there's a business cycle, right?
Yep.
But
Yep.
we're so far away from it. It's just not even worth worrying about yet. Yet.
So I got to throw you a curveball here because I saw a statistic the other day. You've probably seen the same thing, but it was comparing the 70s to the 2010s and housing increase compared to wage growth. Have you
Mhm.
looked into this?
Well, certainly, I mean, look, until 2017, the typical Americans suffered 40 years of no real wage growth. Under
Yeah.
Trump, that finally reversed. It took
Mm-hmm.
4 decades for it to reverse. But the problem is that, there are a lot of abnormal Americans nowadays
Yeah.
because back then, not so many people were entrepreneurs. Most people had a 9 to 5 job, and it was just a very different world. Nobody had a side hustle in the 70s. Okay.
Mm.
Now everybody has a side hustle. So these things are very nuanced, and it's very hard to sort of parse them and understand them. There's just a lot to it. But no question, we're going to talk about wages versus housing affordability and housing obligations. So,
Right. No, and so your deduction at this point, well, let me ask you this. So I just had Harry Dent on, right? And like in
and
Harry's
he's been on
perspective.
my show 11 or 12 times now.
Yep.
He spoke at one of our events. I've been following his work since 1995.
That's
And
awesome.
I like conceptually the concept that Harry is all about, or at least he was originally about,
Mm-hmm.
which was economic demography. Look, I mean, the
Yep.
premise of that is right on. He nails it. You know,
Yep.
people when they're 46 years old, they're going to earn the most, they're going to spend the most, right? You have peak spending years, peak earning years,
Yep.
and there is a cycle to life. There's no
Yep.
question about that. And when you look at the size of the demographic cohorts, you've got the baby boomers that changed the world and changed the economy forever, with 76 million or so of them. You got my generation, Gen X. There's hardly any of us. There's only like 46 million, lonely generation. And then you've got the millennials, the biggest ever, at about 80 million.
Mm.
But the millennials are different than the baby boomers, of course, psychologically, but they have a whole different situation. They have student loans. Baby boomers didn't have that, right? They basically have a mortgage. They just didn't get a house included with it. They got a worthless college degree many times.
Yep. No, that's
It's a
true.
different world.
It,
Yeah, but what about
and
Harry? Go ahead.
no. So like
The
his
sky is
perspective.
falling. I know.
Well, his perspective is yes, everything you're saying is true
Yeah.
as far as the inventory issue, but his concept is that demand can evaporate really quickly when a recession comes. And
And
so,
demand is
how do you
declining.
reconcile that?
Well, I'm not reconciling it. It's true.
Okay.
Demand is declining for housing.
Okay.
Redfin put out a report. Now, it's only one company, of course, and there are
Sure.
much bigger real estate companies than Redfin out there that have much more market share than they do. But they do track how many people are interested on their website of seeing this house, right? And they say that has declined by, don't quote me on this, but I think like 9% or 13% or something like
Okay.
that. Okay. So that did decline a little bit, but you've got to remember that the inventory is so constricted and there is
Mhm.
still so much more demand than there is inventory. We are a long way away, barring some massive increase in interest rates or some other situation,
Something really significant would need
Putin
to
with a
happen.
nuclear warhead or something. Things
Yeah.
can change for sure.
Yeah.
But if the market sort of stays where it is, we're a long way away from a housing recession, although we may enter into an economic recession in the general economy for sure.
Okay. And so you think we could even withstand, the real estate market could withstand an economic recession and a stock market recession, and the real estate prices wouldn't necessarily be negatively impacted?
Oh, sure. No, real
Significantly.
estate's the last man standing. I mean, there's no other asset class that's really working very well right now. The stock market isn't working very well. The crypto market isn't working well. The bond market certainly isn't working. Real estate's the only thing that's working right now.
Yeah, no, that's so okay. So let's shift, if you can, to we got the inventory,
Yeah.
and you do a lot of talking about affordability of housing, right? A lot of people right now speak to the fact that, oh my gosh, housing prices are going up so fast that people aren't going to be able to afford a house. So that on itself is going to put downward pressure on the market. So can
people have these silly ways of thinking about things. I've just never really understood them because they say people aren't going to be able to afford a house. Well, who are those people? I don't know, what that means, right? Like, explain that to me. So here's one thing you're going to see in the media before I go into this part about housing affordability and the mortgage payment, which is really how people buy a house, not on the price. They don't care what the price is as long as the payment is low, right? And the payment's affordable. So we'll go into that in a moment. But I don't want to forget to say this. There are going to be a lot of stories in the news media in the coming months about people who purchase new homes and are being forced to cancel their contracts.
Yep.
And the media will grab hold of that, and so will every YouTuber that wants to make a doom and gloom story. And they'll say, this is the crash. We're in the crash. The market is crashing, right?
Yep.
But they're wrong. Here's why those people are canceling, okay? Imagine this. Some first-time buyer went out and bought a $300,000 home, and they got qualified for that mortgage with every penny they could afford, right?
Yep.
That most people stretch to the max and they buy the maximum house they can qualify for.
Totally.
So 300,000 is the number, for example. Okay. Now, they couldn't lock in their rate as long as the construction took to build the home. Okay. So if that home takes 9 months or a year to build, it used to take 6 months or maybe 8 months, but now it takes longer, supply chain shortages, labor shortages, et cetera. Okay. They couldn't lock the rate in. The rates went up a lot. Okay. They could qualify at 3%, but they can't qualify it at 5.25. Right. So they're out. They have to cancel. The builder will just cancel their contract. And that house does not go unsold. There's a whole another set of people that bought a $400,000 house. And they have the same problem because they bought their maximum based on a 3% interest rate, and they can no longer qualify either. So guess what? They're going to move down and buy that $300,000 house that was just left over by the person who couldn't afford it, who now has to stay in the renter pool.
Got it.
Okay. So everybody moves down the socioeconomic ladder. It's a lot more work for realtors and builders and lenders, for sure. It's a huge hassle.
Yep.
But all of that housing inventory still gets allocated to somebody.
Yep.
Okay. And the rental market at the bottom strengthens because those people stay in the rental market and increase rental demand. Okay.
And it works this way. It works this way because of the fact that we are so short on inventory that's just the natural cycle of things, right? If we had full inventory and it was what it was, and then we had this increase in interest rates, it wouldn't be the same dynamic, right?
That would be different. Yes.
Totally different animal.
Okay. So just understand that it's still a buyer. It's just a different person. Okay. That's the concept I want people to take away. Okay. Just quickly, let me go into a little bit of this. Okay. And you saw this stuff at the presentation. So look, it's not about the price of the house. It's about the payment on the house. And this was especially true when we had the lowest interest rates literally in 5,000 years. I mean, you can find interest rate history dating back 5 millennia, believe it or not. Okay. So let's take a look at the mortgage payment. Okay, now my data in the Hartman Comparison Index, because I want to answer what I think is life's most important question, and that question is compared to what? So I
Mm-hmm.
created an index built around this so that we could use multiple measuring sticks to understand the value of a house, of real estate, or you could use it in the world and understand the value of anything through comparison. And we compare to a whole basket of things, a big list of things. But let's just compare very simply the mortgage payment to inflation. Let's adjust the mortgage payment on the median priced house for inflation. Really a simple thing, right? Because inflation makes the dollar worth less, so a higher payment is actually lower in real terms, okay?
Nominal terms. Yep.
So back in 1970, the mortgage payment on the median price house was $127 a month. I know people are like, really? Yes, really. Okay. By 1980, it went up to 639. We had much higher interest rates and housing prices had gone up too.
Yeah, that's just
By
right after
1990,
Paul Volcker increased the Fed
yep,
funds
that's
rate
the
like crazy. And so
Paul
mortgage rates
Volcker
went through
era.
the roof.
Yeah, he had the
Yeah.
guts to do what no central banker will have today, right?
Yeah, exactly.
And you can see, it went up over time, right? And
Yep.
at the end of the first quarter, when rates were about 4.68%, they're a little higher now. It was
Mhm.
1477 a month.
Yep.
But adjusted for the official rate of inflation according to the Consumer Price Index, it's only 195 a month. So granted, the payment is higher than it was 52 years ago,
Yeah.
okay? But it's not that high. It's higher. I agree completely. So let's look at it and compare it to, say, 2022 years ago, okay? In
Mhm.
2000, the inflation adjusted mortgage payment was 178 per month. Now it's 195. It's a little more, but it's not
Mhm.
much,
Not at
okay?
all.
In 1990, it was actually higher, or sorry, it was only $3 lower according to the CPI, okay? But we know that the CPI is a scam. It's
Yeah,
totally
totally.
manipulated. It's understated. Inflation is really much higher than the CPI would have us believe.
Totally.
It's probably about double. What if now in about 1980 or so, they massively manipulated the way they calculate inflation because inflation was very high and they wanted to make the population seem more content by telling
Yep.
us a lie that inflation was lower. So they rejiggered the whole system and manipulated it in three basic ways: weighting, substitution, and what's called hedonic
Hedonic.
indexing.
Yep.
Okay. And so if we calculate inflation the old way, the way they used to calculate it pre 1980, this is interesting. And this is from a website where I interviewed the founder on my podcast. The website's called shadowstats.com. The founder is a
Okay.
guy named John Williams. And
Nice.
check this out. Here are the shadow stats inflation numbers, calculating inflation the old way. 1970, $127, 1980, 310 because it hadn't changed yet. By 1990, we start to see a disparity, okay? Today, the inflation adjusted payment for a more accurate way to calculate inflation is only $58 a month.
Crazy.
52 years ago, it was double that.
It's nuts.
That's amazing. Now, look, if you don't believe anything I'm saying, that's fine.
Sure.
You don't need to believe me. Just believe the market. Go and look. Forget about what Harry Dent says and what Peter Schiff says and what anybody says, right? Just go look at what's happening. Go out into the marketplace and note that houses go on the market, they sell quick. They sell with multiple offers.
Yep.
Everybody's buying everything. Okay, inventory is low and buyers are still out. Granted, it may not be the fever pitch we had a couple of months ago,
Sure.
but it's still a fever pitch historically. Okay.
Yep.
So people inherently know, even if they say words like, "Oh, it's so expensive," in reality, they still know it's cheap because they keep buying and they keep pushing the prices up further. At the beginning of the year, I predicted prices would increase this year by 12%.
Okay.
And I predicted rents would increase by 8%. And I think I'm going to be right. In fact, I may have been too conservative on my prediction. I don't know. We'll see. Okay.
That's awesome.
We're less than halfway through, but we'll see how it goes. But it's amazing when you really look at these numbers. You see that housing is actually cheaper than it was. 52 years ago. Shocking.
Mhm.
Really
And
shocking stuff. Yeah.
with your thing, you also you do a lot of comparison to housing in real terms compared to commodities, compared to gold, compared to
Yeah.
oil, compared to all these things.
Whole
And it,
bunch of other things in the index that we don't have time for.
yeah, we don't got time
maybe,
for it all, but I
maybe another day I'll come back on the show and we can dive into more of
totally,
those
that's
things.
awesome.
But yeah, happy
So
to.
your synopsis here, I guess thesis is we're in a position where it's not doom and gloom. We're no matter what's going on in the economy, the real estate market, simply because of inventory, and when you look at
Right.
historically, things are not priced as crazy as everybody wants to think that they
Right.
are. When you and when you look at the compared to what kind of concept, the Earth is small compared to the universe, right? Like so,
Right.
it's but to a
Sure.
golf ball, it's huge, right? So it's
Yep.
we have to look at this from through that lens, and when we do that, you think we have at least like this year, I mean, barring anything like
Look,
massively
I mean, if rates
catastrophic.
go to 10%,
Yeah,
all bets are off. Okay.
totally.
I don't know. Okay.
Yeah,
If a nuclear weapon is used, that could change everything. I mean, we've got a war going on, a significant
yeah,
war. Okay.
yeah,
If some event happens like that, of course, all bets are off. But if
totally.
things kind of stay generally where they are now, this is going to go on for another year or two. I mean, there's just not enough inventory to satisfy the demand.
Yeah,
Okay. We have to see, all you need to do is just keep an eye on my podcast, my YouTube channel,
yep,
and I will constantly tell you what the inventory numbers are
yep,
and what the comparison index says. And if you do that, you're going to see the market as it changes, if it
yeah,
changes in any
yep,
significant way. Or, I mean, someday it will change, of course,
totally.
but uh, I, for the next year or two, it's looking pretty solid.
Yeah, and I don't know where you stand on this, but my belief is the Fed is raising rates right now, and so that's obviously putting pressure on interest rates in the economy or whatever. But I feel like they're going to retrace and they're going to go the other direction before they go too high. Like,
Yeah, I don't know. The interest rates, I gave up on trying to predict interest rates. It's really tough. I've been very wrong about that, and I've completely admitted my wrongness on that stuff over the years. But yeah, I
fair
don't know.
enough.
We'll see.
So
See.
that's awesome. So I know we're running up on it, but where can people find you? Just give a pitch.
Yeah. My website is jasonhartman.com, just my name, jasonhartman.com. Of course, I've got a podcast. People can find, just type my name in any podcast platform, and then also my YouTube channel as well. Those would be good things. All
Not
right.
just any podcast either, by the way, guys. He's got like almost 1,500 episodes, I think. I mean, it's
Right. I've got almost 2,000 actually now. So
do you really?
a lot of
Okay,
them.
so prolific
Yep.
production. We'll say that. So, Jason, I just want to say thanks for being here. This is extremely, extremely valuable content. I think it's important to have this perspective. So, guys, if you're watching this, I would really encourage. I'm going to put a link down below if you want to follow Jason's YouTube channel. I'll put a link to his blog, a link to his website, so you can make it easy for you to go find him. And that's it. So thanks for being here, man. And look forward to having you back on again soon, hopefully when things are even going better.
All right. Happy investing to everyone.
All right. Thanks, guys. Have a blessed, inspirational day. We'll talk to you guys soon. See ya.